There is a question that cuts through the noise of Wall Street like a blade. It is a question so simple, yet so profound, that it has the power to dismantle decades of bad financial habits in the instant it is truly understood. It is a question that serves as the ultimate filter, the bedrock of a philosophy that has built one of the world's greatest fortunes from the ground up, in a quiet office in Omaha, Nebraska, far from the frantic energy of Lower Manhattan. This question is the key to transforming your relationship with money, with the market, and with the very concept of ownership. It is Warren Buffett's final promise to the patient investor. The question is this: if you are not willing to own a stock for 10 years, do not even think about owning it for 10 minutes. This isn't a clever soundbite. It is a diagnostic tool for the soul of the business. It is a firewall against speculation, a guardrail against gamblers' ruin, and a direct path to the kind of portfolio that lets you sleep soundly at night, unbothered by the manic chattering of the financial news. Most people treat the stock market like a casino, a place to rent a ticker symbol for a few days or weeks, hoping to catch a lucky break based on a tip, a tweet, or a squiggle on a chart. This is the path of the 99%, a path paved with transaction fees, emotional whiplash, and, ultimately, disappointment. But by embracing the 10-year question, you are not renting a stock. You are making a decision to become a part owner in a durable, high-quality business. This single mental shift forces you to adopt a true owner's mindset. It automatically filters out the fads, the frauds, and the financially fragile. It compels you to seek out companies with unbreachable moats, visionary leadership, and a product or service so essential that its success is a near certainty over the span of a decade. This is not about market timing. It is about time in the market. It's not about predicting the rain. It's about building the ark. Over the next hour, we will deconstruct this single, powerful principle into its 5 core pillars. We will journey through the stories, the psychology, and the practical application of this idea. You will not just learn the question, you will learn how to live by it. You will see how it reshapes your decision-making process, strengthens your portfolio, and sets you on a calmer, more certain path toward true financial freedom. This is the final promise, that by changing the duration of your thinking, you can change the destination of your wealth. The first and most foundational pillar of the 10-year question is a profound psychological transformation, the shift from a renter's mentality to an owner's mindset. To the speculator, a stock is a transient thing, a 3- or 4-letter symbol that flickers on a screen, to be held briefly and flipped for a quick profit. It has no substance, no story, no soul. But to the investor, a share of stock is a tangible piece of a living, breathing business, populated by real people, serving real customers, and creating real value. Adopting this owner's mindset is the first and most crucial step in applying Buffett's long-term philosophy. It changes everything. It changes the questions you ask, the information you seek, and the emotions you feel during inevitable market turbulence. There is no story that illustrates this concept more vividly than Warren Buffett's acquisition of the Nebraska Furniture Mart and his relationship with its legendary founder, Rose Blumkin, better known to the world as Mrs. B. In 1983, Warren Buffett wasn't just looking for another stock to add to the Berkshire Hathaway portfolio. He was looking for great businesses to own permanently. He had heard tales of a retail empire in his own hometown of Omaha. A business started in a basement in 1937 with a mere $500 by a Russian immigrant who couldn't speak a word of English. That immigrant was Rose Blumkin. By the early 1980s, her Nebraska Furniture Mart was doing over $100 million in annual sales, dominating the home furnishings market in the entire region with a brutally simple philosophy: sell cheap and tell the truth. Mrs. B was a force of nature. She was in her late 80s at the time, still zipping around the store on a motorized cart, personally negotiating deals with suppliers and berating employees who failed to meet her impossibly high standards. Buffett was fascinated not by the company's financials, though they were excellent, but by the indestructible culture of ownership that Mrs. B had built. He saw a business that was not just a store but an institution, a testament to one woman's iron will and unimpeachable integrity. So Buffett did what any aspiring business owner would do. He went to meet the proprietor. He didn't send a team of analysts from his wealth management division. He didn't commission a lengthy due diligence report. He wrote a simple 1.5-page letter to Mrs. B, expressing his admiration and his interest in buying her business. Mrs. B, who was notoriously wary of slick-talking businessmen, agreed to a meeting. The negotiation, if you can even call it that, is the stuff of legend. Buffett arrived and asked her a simple question: "How much do you want for the business?" Mrs. B, without a moment's hesitation, replied, $60 million. Buffett asked if she would be willing to have the company's books audited. She refused, allegedly saying, "We have a clean business, we don't have secrets." She trusted her numbers, and she expected him to trust her word. Buffett thought for a moment, looked at this 90-year-old titan of retail, and famously replied, "Mrs. Blumpkin, we'll take it." There was no army of lawyers, no back-and-forth haggling. Just a simple handshake deal for $55 million. She later decided to keep $5 million in cash for herself. Buffett handed over a check, and Berkshire Hathaway became the new owner of the Nebraska Furniture Mart. He didn't even take an inventory of the merchandise. He was buying the business, but more importantly, he was buying the owner's ethos. He knew that with the Blumpkin family still running the show, the business was in the best possible hands. He wasn't renting a retail stock. He was partnering with a commercial genius for the indefinite future. He was so confident in his decision that when he finalized the deal, he said to Mrs. B, "We will not have a contract. It will be my word and your word." This is the owner's mindset in its purest form. It's about assessing the character of the management, the durability of the business model, and the loyalty of the customer base. It's about asking, is this a business I would be proud to own outright, forever? For Buffett with the Nebraska Furniture Mart, the answer was an unequivocal yes. He saw a 10-year, 50-year, 100-year asset. And that simple handshake deal for $55 million has since created a business that generates billions in revenue, a cornerstone of his empire that perfectly embodies the principle of long-term ownership. The profound difference between the renter's and the owner's mindset is rooted in a powerful set of psychological principles, most notably the endowment effect and its close cousin, the IKEA effect. The endowment effect is the well-documented cognitive bias where we place a higher value on an object that we own than we would be willing to pay for the same object if we did not own it. In a famous experiment by Daniel Kahneman, Richard Thaler, and Jack Netsch, participants were given a coffee mug and then offered the chance to sell it. The researchers found that the median selling price the owners demanded was more than twice the median price that potential buyers were willing to offer. The mere act of ownership infused the mug with an added layer of value. When you approach an investment with a 10-year owner's mindset from the very beginning, you are essentially preloading the endowment effect in your favor. You are not just buying a ticker symbol. You are consciously taking ownership of a piece of a business. This psychological framing creates a stronger bond, a deeper sense of commitment. You are less likely to be shaken out by a bad news cycle or a 20% market correction because you feel like you own a piece of the factory, not just a fluctuating price quote. It becomes my company rather than that stock. This shift in language reflects a powerful shift in perspective. The IKEA effect further reinforces this. This principle, named after the Swedish furniture giant, describes our tendency to place a disproportionately high value on things that we have partially created or assembled ourselves. The effort we invest, the hours spent deciphering confusing diagrams and tightening Allen bolts, makes the finished bookshelf feel more valuable to us than an identical, pre-assembled one from a showroom floor. In investing, the assembly is the work of due diligence. When you adopt an owner's mindset, you don't just passively accept a stock tip, you do the work. You read the annual reports, you study the competition, you understand the products, you learn about the management team. This intellectual sweat equity is your IKEA assembly process. By the time you make the investment, you have invested not just your capital, but your time and mental energy. The resulting position in your portfolio feels like something you have built, not something you have merely bought. This deeper connection fosters patience and resilience, the two most critical traits for successful long-term investing. The renter has no such connection. They have no sweat equity. The stock is a commodity, easily discarded at the first sign of trouble, because they have invested nothing of themselves in the decision. They are emotionally and intellectually untethered, making them susceptible to every gust of market fear or greed. The 10-year question forces you to engage in the IKEA effect, to do the work that builds the conviction necessary to hold through thick and thin, transforming a speculative bet into a long-term partnership. So how do you, as a retail investor or an entrepreneur looking to make smart capital allocation decisions, translate this abstract idea of an owner's mindset into a concrete, repeatable process? The answer is to create and follow a business owner's due diligence blueprint before you ever click the buy button. This is a mental model that forces you to step out of the shoes of a stock trader and into the shoes of someone like Mrs. B or Warren Buffett, someone considering buying an entire company outright. First, you must be able to describe what the company actually does in a sentence so simple a child could understand it. If you can't, you don't understand the business well enough to own it. For Coca-Cola, it's, they sell sugar water that people love all over the world. For Geico, it's, they sell car insurance directly to customers, which saves money. If your explanation involves jargon like synergistic blockchain-enabled AI logistics platform, you are likely venturing outside your circle of competence. Second, you must investigate the people running the company. Go to the company's investor relations website and read the biographies of the CEO, the CFO, and the board of directors. Ask yourself, are their incentives aligned with long-term shareholders? Do they have a significant portion of their own net worth invested in the company's stock? Have they been with the company for a long time? Or are they serial job hoppers? Would you be comfortable having these people manage your family's entire net worth? This is a critical step in any wealth management strategy. You are hiring these executives to be the stewards of your capital. Third, analyze the product or service from the perspective of a customer. Why do people choose this company over its competitors? Is it cheaper? Is it higher quality? Is it more convenient? Does it have a powerful brand that evokes trust and loyalty? Try the product yourself if you can. If you're considering investing in Apple, spend time in an Apple store. If you're looking at Starbucks, go buy a coffee and observe the customer experience. This on-the-ground research gives you an intuitive feel for the business that you can never get from a spreadsheet. Fourth, you must understand the company's competitive landscape. Who are their biggest rivals? What is stopping a new competitor from coming in and stealing all their customers? This is the search for a durable competitive advantage, or what Buffett calls a moat. A great business is like a castle, and you want that castle to be protected by a wide, alligator-infested moat that keeps invaders at bay. Finally, and most importantly, perform the 10-year thought experiment. Close your eyes and imagine the world in 10 years. Will this company's product or service still be relevant and in demand? Will its competitive advantage still be intact? Some businesses are easy to predict. People will still be drinking Coke, brushing their teeth with Colgate, and insuring their homes in 10 years. For other businesses, especially those in rapidly changing technology sectors, the 10-year view is much foggier. The goal of this blueprint is not to find a sure thing. No such thing exists. The goal is to force a deeper level of inquiry, to move beyond the ticker and into the business, building the intellectual and emotional foundation required for true long-term ownership. To truly appreciate the power of the owner's mindset, we must examine its antithesis, the path of the 99%, the world of the stock renter. This is the frantic, high-stress world of day trading, swing trading, and chasing hot tips. The stock renter wakes up, and the first thing they do is check pre-market futures. Their screen is a chaotic mosaic of charts with moving averages, RSI indicators, and Bollinger Bands. Their day is a roller coaster of emotions, dictated by the green and red flashes of the ticker tape. They are not investing in businesses, they are betting on squiggles. Their decision-making is driven by a constant stream of external stimuli, a news headline about the Federal Reserve, an analyst upgrade on CNBC, a rumor in a Reddit forum, or a cryptic tweet from a market guru. Imagine an investor, we'll call him Tom. Tom hears from a friend that a small biotech company is on the verge of a major breakthrough with a new drug. The stock is soaring. The fear of missing out, or FOMO, kicks in. Tom does no research on the company's financials, its management, or the science behind the drug. He doesn't need to. He's just renting the stock for the ride-up. He buys a large position, and for a few days he feels like a genius as the stock continues to climb. He's checking his brokerage account every 5 minutes, his heart pounding with every tick. Then, the company releases its clinical trial data. It's not the home run everyone expected. The results are ambiguous. The stock plummets 30% in a single morning. Panic sets in. Tom has no foundation of conviction to fall back on. He doesn't understand the business, so he has no way to assess whether this is a temporary setback or a fundamental disaster. All he sees is his money vanishing. His fear response screams, "Sell!" and he dumps his entire position at a massive loss. A few months later, the company clarifies its data, announces a new trial, and the stock slowly begins to recover, eventually surpassing its previous high. But Tom is long gone. He's already chasing the next hot tip in a different sector. This cycle repeats itself endlessly. The renter is always late to the party, and the first to flee when the music stops. Their portfolio is a revolving door of transient positions, each one chipping away at their capital through trading fees, bid-ask spreads, and, most destructively, emotional mistakes. They violate the cardinal rule of investing: buy low, sell high. Instead, they are wired to buy high on euphoria and sell low on panic. This is not a strategy for building wealth. It is a recipe for churning your account down to zero, a guaranteed failure to achieve any meaningful portfolio growth. The direct financial connection between an owner's mindset and superior returns is not theoretical. It is mathematically undeniable and manifests on your financial statements in several powerful ways. The first and most obvious impact is the dramatic reduction in transaction costs. Every time a stock renter buys or sells, they are paying a commission, or, more insidiously, a bid-ask spread. These small costs seem insignificant on a single trade, but when multiplied over hundreds of trades a year, they act as a powerful anchor, dragging down performance. An owner who might only make a handful of carefully considered transactions in a decade, largely bypasses this wealth-destroying friction. The second, and far more significant, financial advantage is the preferential treatment of long-term capital gains taxes. In the United States, if you hold an asset for more than a year, the profit from its sale is taxed at a much lower rate than your ordinary income. Short-term gains from assets held for less than a year are taxed at your highest marginal income tax rate. For a high-income individual, this difference can be enormous, often 20% or more. The stock renter is constantly realizing short-term gains, handing over a huge slice of any potential profits to the government. The long-term owner, by contrast, lets their investments compound for years, even decades, in a tax-deferred state. The money that would have been paid in taxes each year remains invested, earning its own returns. This tax deferral is like a government-sponsored, interest-free loan that turbocharges your compounding machine. It is one of the most powerful, yet overlooked drivers of long-term portfolio growth. But the most profound financial benefit is the avoidance of unforced errors. The great tennis player Bjorn Borg was said to have won his championships not by hitting more winners, but by making fewer mistakes. The same is true in investing. The majority of underperformance comes not from bad ideas, but from good ideas that are abandoned at the worst possible moment. The owner's mindset, built on a foundation of deep research and conviction, is the ultimate defense against this. When the market inevitably panics, the renter, with no conviction, panics with it and sells. The owner, who understands the underlying business, sees the panic not as a threat, but as an opportunity. They recognize that the price of their high-quality business has just gone on sale, and they are psychologically prepared to hold or even buy more. Over a lifetime of investing, this behavioral advantage is worth more than any stock-picking algorithm or trading system. By simply eliminating the catastrophic losses that come from panic selling, the long-term owner ensures they will be present for the market's eventual recovery and its inexorable upward climb. The 10-year question, therefore, is not just a philosophical guide. It is a ruthlessly practical financial tool. It reduces costs, optimizes for taxes, and, most importantly, armors you against the single greatest threat to your financial freedom: your own emotional impulses. It is the first step in a professional approach to wealth management, whether you're managing a $10,000 account or a $10 billion fund. The second pillar of the 10-year philosophy is its function as the ultimate quality filter. If the first pillar is about changing your mindset, this one is about changing your standards. The 10-year question forces you to look beyond the immediate quarter, the current news cycle, or the next product launch, and to focus exclusively on the single most important characteristic of a great investment: durability. A company that can not only survive but thrive for a decade or more in a competitive capitalist economy must possess a special, almost magical quality. It must have a deep, structural advantage that protects it from the relentless onslaught of competitors. Warren Buffett calls this a moat. By asking if you're willing to hold a stock for 10 years, you are implicitly asking, does this business have a wide, sustainable moat? This question acts as a powerful sieve, automatically filtering out 99% of the investment universe: the faddish, the fragile, and the fundamentally flawed, leaving you with a concentrated portfolio of truly exceptional businesses. The perfect story to illustrate this principle in action is Buffett's masterstroke investment in American Express during the infamous salad oil scandal of 1963. In the early 1960s, American Express was a blue-chip darling, a respected and seemingly unshakable institution. Its core businesses were travelers' checks and credit cards, both built on the bedrock of absolute trust. But a small, obscure division of the company was involved in a practice called field warehousing, essentially lending money against a company's inventory. One of their biggest clients was the Allied Crude Vegetable Oil Refining Corporation, run by a charismatic fraudster named Tino DeAngelis. DeAngelis had devised a brilliant scam. He would fill giant storage tanks mostly with seawater, with only a thin layer of valuable salad oil floating on top. He then used falsified inventory receipts for this, quote, salad oil to secure massive loans from dozens of banks, with American Express's warehousing division guaranteeing the collateral. In November 1963, the fraud was exposed. Allied Crude defaulted, and it became clear that the $175 million in collateralized oil simply didn't exist. Wall Street panicked. How could the venerable American Express have been so thoroughly duped? The narrative quickly became that the company's reputation was ruined. If they couldn't be trusted to properly inspect a tank of salad oil, how could anyone trust their travelers' checks? The stock collapsed, losing 50% of its value in a matter of months. The street was dumping the stock, convinced American Express was headed for bankruptcy. This is where Warren Buffett, then a young, relatively unknown fund manager, saw not a crisis but an opportunity. Instead of reading the panicked headlines, he asked the 10-year question. He asked himself, has the fundamental moat of the core business been permanently damaged by this scandal in a peripheral division? To answer this, he didn't look at a stock chart. He did on-the-ground, investigative work. He went out to restaurants and banks. He talked to merchants, customers, and travel agents. He would ask them, since the salad oil scandal, have you been using fewer American Express travelers' checks? Are you less likely to accept the American Express card? The answer, overwhelmingly, was no. People still trusted the brand. Competitors were even running ads that inadvertently highlighted the strength of American Express, saying things like, "Use our travelers' checks. they're as good as American Express. He realized that the brand's power in the minds of consumers, its intangible moat, was completely intact. The market was panicking over a temporary fixable problem in a non-core part of the business, while ignoring the enduring strength of the main franchise. Convinced that the market was making a massive emotional error, Buffett invested 40% of his entire partnership's capital into American Express stock. It was an incredibly concentrated, high-conviction bet. Over the next few years, as the scandal faded from memory and the core business continued its powerful growth, the stock roared back, netting a fortune for Buffett's partners. He used the 10-year test as a filter. It allowed him to ignore the terrifying short-term narrative and focus on the long-term, durable reality of the business's competitive advantage. The market's hysterical reaction to the salad oil scandal and Buffett's cool-headed response is a perfect illustration of two powerful cognitive biases: recency bias and the availability heuristic. Recency bias is our natural tendency to give greater importance to more recent events. For the investors of 1963, the most recent event was the shocking, embarrassing fraud. The headlines were fresh, the losses were immediate, and this recent information dominated their decision-making process, causing them to forget the decades of trust and brand building that preceded the scandal. They extrapolated the recent disaster far into the future, assuming permanent damage from a temporary event. The 10-year question is a powerful antidote to recency bias because it forces you to zoom out. It compels you to weigh the importance of last week's news against the business's performance over the last decade and its likely prospects over the next one. It puts the recent event in its proper, long-term context. The availability heuristic is a mental shortcut where we rely on immediate examples that come to mind when evaluating a specific topic or decision. When the scandal broke, the examples that were most available to investors' minds were stories of fraud, bankruptcy, and corporate collapse. The dramatic, sensational nature of the news made it highly available, causing investors to overestimate the probability that American Express would fail. Buffett, by contrast, deliberately sought out less available, but more relevant, information. The quiet confidence of a restaurant owner still accepting the Amex card is not a dramatic headline. The boring, everyday transaction of a traveler buying a traveler's check is not newsworthy. But this mundane, less available data was the true signal of the company's underlying health. The 10-year filter is a systematic process for overriding the availability heuristic. It forces you to ignore the easily accessible, sensationalist noise, the scandal, and actively search for the harder-to-find, more durable evidence of a company's quality, its brand loyalty, and customer behavior. It's a conscious choice to favor the signal of long-term business reality over the noise of short-term market sentiment. This disciplined approach is essential for any strategy aiming at beating the S&P 500, as the market index is often swayed by these very biases, creating opportunities for the rational investor. To apply this filtering principle to your own stock-picking process, you need a practical blueprint for identifying and evaluating these durable competitive advantages. This is the moat assessment framework, a mental model that breaks down Buffett's concept of a moat into 4 distinct categories. Before you invest in any company for the long term, you must be able to clearly identify which of these moats, if any, it possesses. The first type of moat is intangible assets. This includes things like brands, patents, and regulatory licenses. A brand like Coca-Cola is a powerful moat because it creates a Pavlovian response in the minds of billions of consumers. People are willing to pay a premium for Coke over a chemically identical generic cola simply because of the century of positive associations built into the brand. Patents protect pharmaceutical companies, and government licenses protect utilities. Ask yourself, does this company have a brand that commands pricing power or a patent that locks out competitors? The second type of moat is switching costs. This exists when it is too expensive, time-consuming, or risky for a customer to switch from your product to a competitor's. Think about your local bank. Moving all your automated payments and direct deposits to a new bank is a massive headache, so you stick with your current one, even if a competitor offers a slightly better interest rate. Enterprise software companies like Microsoft and Oracle have enormous switching costs. Entire corporations build their workflows around their systems, making it nearly impossible to rip them out. Ask yourself, how difficult would it be for this company's customers to leave for a competitor? The third moat is the network effect. This occurs when a product or service becomes more valuable as more people use it. Facebook is the classic example. The value of being on Facebook is that all your friends are there. A new social network, even with better features, would struggle to compete because it lacks the network. Credit card companies like Visa and American Express have a two-sided network effect. More customers with Visa cards attract more merchants to accept Visa, which in turn makes the card more valuable to customers. Ask yourself, does this business get stronger as it gets bigger? The fourth and final moat is a cost advantage. This allows a company to produce its product or service at a lower cost than its rivals, enabling it to either undercut them on price or earn higher profit margins. Geico has a cost advantage over traditional insurers because its direct-to-consumer model bypasses the expensive agent network. Costco has a cost advantage due to its massive scale, allowing it to negotiate rock-bottom prices from suppliers and pass the savings on to members. Ask yourself, does this company have a structural cost advantage that competitors cannot replicate? By using this framework, the 10-year question becomes more concrete. You're no longer just guessing about the future. You are systematically analyzing the specific structural characteristics that will allow a business to survive and prosper for the next decade. This is the core of quality investing and a critical skill for any serious retail investor. The antithesis to this disciplined search for quality and durability is the siren song of the, quote, story stock. This is the path of the 99%. Particularly during speculative bubbles. A story stock is a company, often in a hot, emerging industry, that has a captivating narrative but little to no actual profits, revenue, or defensible moat. The investment thesis is based not on current reality, but on a grand vision of a future that may or may not materialize. The dot-com bubble of the late 1990s was the golden age of the story stock. Investors, mesmerized by the revolutionary potential of the internet, threw money at any company with a .com at the end of its name. They bought into stories, not businesses. Take a company like Pets.com. The story was compelling. They were going to revolutionize the pet supply industry by selling dog food online. They had a catchy name and a famous sock puppet mascot that even appeared in the Super Bowl. The stock IPO'd to great fanfare. But the business model was fundamentally flawed. They were selling heavy bags of dog food at or below cost and then spending a fortune to ship them across the country. There was no moat, no cost advantage, and no path to profitability. Investors who asked the 10-year question would have been forced to confront this reality. How exactly would this company be a thriving, profitable enterprise in 2010? What was stopping Amazon or Walmart from selling pet food online more efficiently? There were no good answers. But in the euphoria of the bubble, no one was asking these questions. They were buying the story. The inevitable outcome was a complete wipeout. Pets.com, along with hundreds of other story stocks like Webvan and eToys, went bankrupt, and their stocks went to zero. Portfolios were decimated. People who had thought they were on the cusp of achieving financial freedom saw their dreams evaporate because they had mistaken a good story for a good business. This pattern repeats in every market cycle. In recent years, we've seen it with speculative cannabis stocks, money-losing electric vehicle startups, and a host of other companies that were long on narrative and short on fundamentals. The speculator who chases these stories is making a bet on a low-probability outcome. They are hoping to catch lightning in a bottle. The quality investor, armed with the 10-year filter, is doing the opposite. They are patiently looking for businesses whose success is a high-probability outcome. Businesses protected by deep moats that make their future profitability all but inevitable. The story stock investor is playing the lottery. The quality investor is stacking the odds relentlessly in their favor. The direct financial connection between a quality-filtered, moat-focused portfolio and long-term wealth is profound and quantifiable. The presence of a strong moat manifests directly on a company's financial statements in the form of superior and consistent profitability. The key metric to look for is a high return on invested capital, or ROIC. ROIC measures how efficiently a company is using its capital to generate profits. A company that can consistently generate a high ROIC, say above 15%, is likely to have a strong moat. The moat allows it to fend off competition and maintain high profit margins. A company in a brutally competitive, commodity-like industry will see its ROIC competed down toward its cost of capital. A company with a moat can defy this gravitational pull. This superior profitability has a direct impact on your portfolio growth. High ROIC companies are prodigious generators of free cash flow, cash that can be used to pay dividends, buy back shares, or reinvest in the business to fuel further growth. This creates a virtuous cycle. The moat protects the profits generate cash, and the cash is reinvested to widen the moat and generate even more profits. This is the engine of compounding at the corporate level, which translates directly into compounding at the portfolio level. Furthermore, a moat provides a crucial margin of safety. A business with high margins and a loyal customer base can withstand economic downturns or management missteps far better than a fragile low-margin competitor. This resilience means you are less likely to suffer a permanent loss of capital, which is the most important rule of investing. When you filter your investment universe using the 10-year test, you are systematically tilting your asset allocation toward these high ROIC resilient businesses. Over time, this approach creates a portfolio that looks very different from the broader market. It will be less cyclical, more profitable, and composed of companies that are true capital allocators. While the S&P 500 contains a mix of great, good, and mediocre businesses, your quality-filtered portfolio will be a concentrated collection of the great ones. This is how you gain an edge. It's not about finding a secret stock. It's about having the discipline to only invest in the highest quality businesses and the patience to let their superior economics work for you over the long run. This is the strategy that moves you from simply participating in the market to systematically positioning yourself to beat it. The third pillar that supports the 10-year question is the incredible power that comes from ignoring the noise. In our hyper-connected world, we are drowning in a tsunami of financial information. Every minute there are new headlines, new analyst ratings, new economic data points, new rumors, and new predictions. The vast majority of this information is not just useless, it is actively harmful to your financial health. It is noise, designed to provoke an emotional reaction and trigger an action, usually a transaction that benefits a broker, not you. The 10-year question is a powerful declaration of independence from this noise. By committing to a decade-long holding period, you are making a conscious decision that the day-to-day chatter of the market is irrelevant to your long-term success. You are choosing to focus on the signal of underlying business performance, not the noise of fluctuating stock prices. No one has embodied this principle more completely than Warren Buffett himself, whose entire life and career can be seen as a masterclass in strategic ignorance. The most powerful symbol of Buffett's philosophy is his physical location. In an industry where proximity to the action is seen as a prerequisite for success, he chose to build his empire, Berkshire Hathaway, not on Wall Street, but in a modest office in Omaha, Nebraska, nearly 1,200 miles away. This was not an accident. It was a deliberate choice to insulate himself from the infectious, short-term-oriented groupthink of the financial industry. In New York, you are constantly bombarded with tips, rumors, and the prevailing sentiment of the herd. In Omaha, Buffett could sit in his office, undisturbed, and do the one thing he felt was most crucial for an investor: read and think. His office famously has no stock ticker, no Bloomberg terminal flashing quotes. He might go an entire day without knowing whether the market was up or down, and he wouldn't care. He is focused on the value of his businesses, not their daily price. The story of the 1987 Black Monday crash perfectly captures the power of this detachment. On October 19, 1987, the Dow Jones Industrial Average plunged 508 points, a staggering 22.6% in a single day. It was, and remains, the largest one-day percentage drop in the market's history. Panic gripped Wall Street. Brokers were screaming, investors were weeping, and the financial system seemed to be on the brink of collapse. The noise was deafening. In Omaha, Warren Buffett's day was remarkably calm. He received a call from a frantic broker in New York, describing the chaos. Buffett's reaction was not fear, but a cold, rational opportunism. He saw that the prices of the great American businesses he owned or wanted to own were being slashed for reasons that had nothing to do with their long-term earning power. The fear of the herd was creating a once-in-a-generation buying opportunity. While others were frantically selling, consumed by the terrifying noise of the crash, Buffett calmly began looking for bargains. He famously told a reporter, "It's an ideal time to be buying stocks." He later explained his thinking with a simple analogy. If you planned to be a net buyer of hamburgers for the rest of your life, you would rejoice when the price of hamburgers went down, not panic. It was the same with stocks. Because his time horizon was decades, not days, a market crash was good news. His physical and mental distance from the epicenter of the panic allowed him to maintain his rational, long-term perspective. He was able to execute his strategy with precision because he had built a system to filter out the deafening, emotional noise of the market. This is the power of the 10-year mindset. It transforms a terrifying crisis into a welcome opportunity. Buffett's ability to remain calm during Black Monday is a testament to his mastery over a pair of cognitive biases that derail most investors: the narrative fallacy and information overload. The narrative fallacy, a term coined by Nassim Nicholas Taleb, describes our innate tendency to create stories to explain random sets of facts. Our brains are uncomfortable with randomness and complexity, so we weave simple, cause-and-effect narratives to make sense of the world. The financial media is a giant machine for generating these narratives. On a day the market goes up, they will create a story about investor optimism over a trade deal. On a day it goes down, they will craft a narrative about renewed fears of inflation. These stories are almost always post hoc rationalizations of random price movements, yet we find them irresistible. They give us a false sense of understanding and control. The 10-year investor, by focusing on the business fundamentals over a decade, starves their brain of the daily inputs needed to create these fallacious narratives. They are not trying to explain why the market went down 1% yesterday. They are trying to understand if a company's return on capital will be excellent over the next 10 years. This focus on the long-term fundamentals breaks the spell of the daily story. The second related problem is information overload. It is a common misconception that more information leads to better decisions. In reality, beyond a certain point, more information leads to more noise, more confusion, and less confidence. This is particularly true in investing, where we are bombarded with an endless stream of data, much of it contradictory and irrelevant. An investor who tries to process every economic report, every analyst upgrade, and every CEO interview will find themselves paralyzed by analysis, or, worse, whipsawed into constant action based on the latest piece of data. This is what psychologists call decision fatigue. The more decisions you make, the worse the quality of those decisions becomes. Buffett's strategy of ignoring the daily noise is a brilliant system for combating information overload. By consciously limiting his information intake to only the highest quality, most relevant sources, primarily annual reports and industry publications, he preserves his mental energy for the few decisions that truly matter. The 10-year question is the ultimate information filter. It makes 99% of the data that flows from the financial media completely irrelevant. The latest jobs report simply does not affect the 10-year outlook for See's Candies. A Federal Reserve chairman's speech has no bearing on Geico's cost advantage. This strategic ignorance is not a sign of laziness. It is a sign of profound intellectual discipline. To put this pillar into practice, you must adopt what can be called an information diet for investors. This is a practical, step-by-step blueprint to curate your information environment and protect yourself from the corrosive effects of market noise. This is not about being uninformed, it's about being selectively informed. The first step is to perform a digital cleanse. Go to your smartphone right now and delete any apps that provide real-time stock quotes or breaking financial news from your home screen. The mere presence of these apps is a constant temptation to check prices, which reinforces a short-term mindset. Move them to a folder on your last screen, or better yet, delete them entirely. You can check your portfolio on a desktop computer when you choose to, not when a notification prompts you to. Step 2 is to unsubscribe. Go through your email inbox and ruthlessly unsubscribe from any newsletter or market alert service that promises, quote, hot stock tips, market-beating secrets, or daily market commentary. This content is engineered to create a sense of urgency and FOMO, not to provide deep insight. It is the junk food of the information world. Step 3 is to replace the bad with the good. The time you previously spent consuming financial junk food should now be dedicated to consuming high-quality, long-form content. Your goal is to shift your focus from prices to businesses. Instead of watching an hour of CNBC, commit to reading one company's annual report, the 10K filing, each week. These documents, written by management for shareholders, contain a wealth of information about the company's strategy, risks, and financial health. It's the raw material that Buffett uses. Start with companies you already know and use as a consumer. This disciplined practice will slowly but surely build your business acumen and retrain your brain to think like an owner, not a speculator. Step 4 is to schedule your interactions with the market. Instead of reacting to the market's whims, you will dictate the terms of your engagement. Establish a set schedule for reviewing your portfolio. For most long-term investors, once a quarter is more than sufficient. Put it on your calendar like a doctor's appointment. During this review, you will assess whether the long-term theses for your investments remain intact. You will not sell because a stock is down, or buy because it is up. You will only make a change if the fundamental 10-year outlook for a business has genuinely deteriorated. This simple, disciplined routine breaks the cycle of reactive, emotional decision-making and is a key step for any retail investor seeking to professionalize their process and achieve peace of mind. The antithesis of this calm, disciplined approach is the life of the 24/7 finance news junkie. This individual is a prisoner of the information fire hose. Their day starts and ends with the market. They wake up to check Asian market performance and go to bed after seeing how the U.S. futures are setting up for the next day. Their television is permanently tuned to a financial news network, with a scrolling ticker at the bottom of the screen providing a constant, hypnotic drip of price changes. They have multiple browser tabs open to different financial websites, and their phone buzzes incessantly with alerts from their brokerage app. This person believes they are gaining an edge by being hyper-informed. In reality, they are the market's puppet. Their emotional state is directly tied to the intraday gyrations of their portfolio. A green day brings euphoria and overconfidence. A red day brings anxiety and fear. They are perpetually engaged in what is known as, quote, recency bias, overreacting to the latest piece of news as if it is the most important event in history. An analyst downgrades one of their stocks, they feel a surge of panic and consider selling. A positive jobs report comes out, they feel a rush of optimism and consider adding more risk to their portfolio. They are constantly tinkering, trimming a position here, adding a new one there, always reacting, never thinking. They spend countless hours researching, but their research is a mile wide and an inch deep. They know the latest quarterly earnings per share number for a dozen companies, but they can't tell you anything about their durable competitive advantages. Their portfolio churns constantly, racking up transaction costs and short-term capital gains taxes that act as a severe headwind to performance. This is not just a financially suboptimal way to live, it is an emotionally exhausting one. It creates a state of perpetual anxiety and robs the investor of the very thing that wealth is supposed to provide: freedom. The finance news junkie is not on the path to financial freedom. They are on a hamster wheel, running faster and faster but going nowhere. all while the disciplined long-term investor sits quietly, letting the power of compounding and quality businesses do the heavy lifting for them. The direct financial connection between ignoring the noise and building wealth is one of the most well-documented phenomena in behavioral finance. The financial benefit is often called behavioral alpha. Alpha is the term for returns that are above and beyond what the market provides. While most people hunt for alpha by trying to pick better stocks, the evidence shows that the largest source of alpha for most investors comes not from what they buy, but from what they don't do. Specifically, it comes from avoiding emotionally driven buying and selling. Year after year, studies conducted by firms like Delbar show that the average retail investor's returns significantly underperform the S&P 500 index. This isn't because they own bad investments, it's because they time their own investments poorly. They reliably buy after a period of strong performance, buying high, and sell after a period of poor performance, selling low. This value-destroying behavior is a direct result of paying too much attention to the market's noise. The noise creates excitement and greed on the way up, and fear and panic on the way down, prompting them to act at precisely the worst moments. By adopting the 10-year mindset and the information diet that it entails, you are building a behavioral moat around your portfolio. You are insulating your decision-making process from the very inputs that cause the average investor to fail. Let's quantify this. If the market returns an average of 10% per year, and the average investor, due to poor timing, only earns 7% per year, that 3% gap is the, quote, behavioral cost. Over 30 years, on a $100,000 investment, that 3% gap is the difference between ending up with $574,000 versus $745,000. The financial impact is staggering. It's the difference between a comfortable retirement and a struggle. Your ability to ignore the noise and avoid these behavioral traps is a more powerful determinant of your long-term wealth than your ability to find the next great growth stock. In the world of wealth management, this is a key insight. The best advisors spend less time talking about stock picks and more time acting as behavioral coaches, helping their clients stick to a long-term plan and tune out the noise. When you commit to the 10-year question, you become your own behavioral coach. You create a system that forces discipline and patience, ensuring that you, not your emotions, are in control of your financial destiny. This behavioral alpha is the purest form of financial advantage, and it is available to anyone willing to simply turn down the volume. This leads us to the fourth pillar, the mathematical engine that drives the entire 10-year philosophy, the awesome power of compounding. Compounding is what Albert Einstein supposedly called the eighth wonder of the world. It's the process of generating earnings on an asset's reinvested earnings. It is a force of exponential growth, a snowball rolling down a very long hill. But the magic of compounding has one crucial, non-negotiable ingredient: time. A long, uninterrupted runway of time. The 10-year question is not an arbitrary number. It is a conscious commitment to provide your investments with the one thing they need most to unleash their true potential. By refusing to even consider an investment you wouldn't hold for a decade, you are aligning your strategy with the fundamental physics of wealth creation. You are moving from the linear world of addition to the exponential world of multiplication. No investment better illustrates Buffett's mastery of this principle than his 1972 purchase of See's Candies. In the early 1970s, Buffett and his partner Charlie Munger were presented with the opportunity to buy See's Candies, a well-loved family-owned chocolate company based in California. See's was a good business, but it wasn't a spectacular growth company. It had a strong brand, loyal customers, and consistent, modest profits. Buffett's protege, Robert Flaherty, recommended they buy it for $25 million. At the time, this seemed like a high price. The company was only earning about $2 million after tax, so the price was more than 12 times earnings, and it had very little in the way of tangible assets. It was far more than Buffett, a student of the Graham and Dodd school of cigar-butt value investing, was used to paying. His instinct was to pass. But Charlie Munger pushed him. Munger saw something deeper. He saw a quality business with a hidden moat. Pricing power. Because of the brand's powerful association with quality and gift-giving, See's could raise its prices a little bit each year without losing customers. This small act, repeated year after year, would produce a steadily growing stream of cash that required very little additional capital investment. Munger convinced Buffett to pay the $25 million. This decision marked a pivotal moment in Buffett's evolution as an investor. He was moving from buying fair companies at wonderful prices to buying wonderful companies at fair prices. And the See's Candies investment became the poster child for the power of long-term compounding fueled by a quality business. That initial $25 million purchase has since been a gusher of cash for Berkshire Hathaway. Over the decades, See's has generated more than $2 billion in pre-tax earnings for Berkshire. This is cash that Buffett and Munger were able to pull out of the business each year and reinvest into other wonderful companies, like Coca-Cola and American Express. The genius of the investment was not in some brilliant turnaround or explosive growth. It was in recognizing a simple, durable business that could be held for decades, allowing the slow, steady magic of compounding to do its work. If Buffett had adopted a short-term renter's mindset, he would have never bought See's in the first place. It was too expensive based on the metrics of the day. And if he had sold it after a few years for a quick 50 or 100% profit, he would have felt smart, but he would have forfeited the billions of dollars in value that were created by simply holding on and letting this magnificent compounding machine run for half a century. The 10-year question forces you to seek out businesses like See's Candies, companies that you can just own, and let time work its magic. The reason most people fail to harness the power of compounding is a deep-seated cognitive bias known as hyperbolic discounting. This is our brain's powerful tendency to prefer smaller, immediate rewards over larger, later rewards. We are, by our evolutionary wiring, creatures of the present. Our ancestors needed to prioritize the immediate reward of finding food today over the larger, uncertain reward of a bigger food source next month. This short-term preference is hardwired into our neural circuitry. In the modern world, this manifests as impatience. We would rather take a guaranteed $100 today than be promised $200 a year from now, even though the latter is a far better financial decision. The stock market renter is a victim of hyperbolic discounting. They are constantly seeking the small, immediate gratification of a quick 10% gain. The thrill of a winning trade today is far more appealing to their brain than the abstract, distant promise of a massive gain in 10 years. They are psychologically incapable of playing the long game. The 10-year question is a powerful commitment device designed to override this self-destructive short-term instinct. It is a pre-commitment to patience. By making the 10-year holding period a non-negotiable rule of your investment process, you are forcing your rational, long-term thinking brain, your prefrontal cortex, to take control from your impulsive, short-term emotional brain. You are creating a rule that prevents you from succumbing to the temptation of the immediate reward. It's like Odysseus tying himself to the mast to resist the siren song. The siren song of the market is the allure of quick, easy money. The 10-year rule is your mast. It recognizes that willpower is a finite resource. You cannot simply will yourself to be a patient investor day after day. Instead, you must build a system, a set of unbreakable rules that makes patience the default option. By doing so, you align your actions with the mathematical reality of compounding, ensuring that you are the beneficiary of exponential growth, rather than a victim of your own innate psychological biases. This disciplined approach is the foundation of any serious plan for long-term portfolio growth and eventual financial freedom. To operationalize this principle, you can create what I call the personal compounding machine. This is a simple four-step blueprint that anyone can follow to put their wealth on an exponential trajectory. Step 1 is to populate your portfolio exclusively with high-quality businesses that possess the moats we discussed earlier. The key is that these businesses must be prodigious generators of free cash flow. This is the fuel for your compounding machine. A business that constantly consumes cash to grow is not a good candidate for this strategy. You want businesses that gush cash. Step 2 is to automate your reinvestment. For any stocks that pay dividends, enroll them in a dividend reinvestment plan, or DRIP. This can usually be done with a single click in your brokerage account. A DRIP automatically uses your dividend payments to buy more shares or even fractional shares of the same company. This creates a positive feedback loop. Your shares pay dividends, those dividends buy more shares, and those new shares pay even more dividends. It's compounding on autopilot. This simple automated action is one of the most powerful wealth-building tools available to the retail investor. Step 3 is to add new capital intelligently. Whenever you have new money to invest, from your salary or other income, your default action should be to add it to the best businesses you already own. You should especially seek to do this during market downturns, when the prices of these great businesses are temporarily depressed. This is how you pour gasoline on the compounding fire. This requires the emotional fortitude we discussed in the previous pillar, but it is a critical step for accelerating your returns. Step 4, and this is the hardest step for most people, is to do nothing. Once your machine is built and fueled, you must let it run. Do not interrupt the compounding process for frivolous reasons. Do not sell a great business to lock in a gain. Do not sell because you are scared of a recession. You must have the patience to let the snowball gather mass and momentum as it rolls down that long, 10-year hill. To visualize the power of this, consider this. If you invest $10,000 and earn a 10% average annual return, after 10 years you will have about $26,000. But after 30 years, you will have over $174,000. The last few years of a long holding period generate the majority of the gains. The personal compounding machine is a blueprint for ensuring you are there to collect them. The antithesis of the patient compounder is the person with a get-rich-quick mentality. This mindset is not about investing. It's about searching for a financial shortcut, a lottery ticket. It is an attempt to get the reward without the process, the harvest without the planting. This mentality is fueled by stories of overnight millionaires from a lucky crypto trade or a meme stock frenzy. These stories, amplified by social media, create a distorted view of how wealth is actually built. They make the slow, steady process of compounding seem boring and inadequate. The get-rich-quick seeker is drawn to things that promise exponential returns in a short period of time, highly speculative penny stocks, complex options trading strategies they don't understand, or leveraged financial products. They are playing a game with a high probability of ruin. They are like a gardener who plants a seed and then digs it up every day to see if it's growing. Their impatience prevents anything from ever taking root. This mentality is also deeply susceptible to scams and fraudulent schemes. The promise of guaranteed high returns is a siren song for the impatient and the greedy. They fall for Ponzi schemes and other financial traps because they want to believe in the shortcut. The disciplined long-term investor, armed with the 10-year question, is almost immune to these temptations. The 10-year filter immediately disqualifies 99% of get-rich-quick schemes. You cannot reasonably project that a speculative cryptocurrency will be a dominant, thriving asset in a decade. You cannot be confident that a penny stock with no revenue will be a successful business. The question forces a level of prudence and realism that is the mortal enemy of the get-rich-quick mindset. Warren Buffett's wealth was not built overnight. It was built over 80 years of disciplined saving, intelligent investing in quality businesses, and the uninterrupted compounding of his capital. Over 99% of his net worth was earned after his 50th birthday. He is the ultimate testament to the power of playing the long game. The get-rich-quick path is an illusion. The get-rich-slow path is a time-tested certainty. The direct financial connection of a compounding-oriented strategy is the very definition of exponential portfolio growth. Let's break down the math. If you simply earn a return and spend it, your wealth grows through addition. But when you reinvest your earnings, your wealth grows through multiplication. The rule of 72 is a simple mental model to understand this. If you divide 72 by your annual rate of return, it will tell you roughly how many years it takes for your money to double. At a 10% annual return, your money doubles approximately every 7.2 years. At a 7% return, it takes about 10 years. This shows why even small differences in your long-term return rate have a massive impact over time. The key is that the doubling happens on an ever larger base. The first doubling might take your $10,000 to $20,000. The next doubling takes your $20,000 to $40,000. Later on, a doubling will take your $500,000 to $1 million. The growth is not linear, it's explosive. When you adopt the 10-year question as your guiding principle, you are making a conscious decision to maximize the number of doubling periods your capital will experience. Every time you sell a winning investment early to lock in a gain, you are resetting the clock. You pay taxes on the gain, reducing your capital base, and then you have to find a new investment that is as good as the one you just sold. You are interrupting the compounding process. A long-term owner of a high-quality business, by contrast, lets that business compound internally, tax-free, for decades. The value of the business grows, and the stock price eventually follows. This uninterrupted compounding is the single most powerful force for wealth creation on the planet. This concept is the bedrock of all retirement planning, wealth management, and strategies for achieving financial freedom. The difference between a portfolio that is allowed to compound for decades and one that is constantly churned is not a small difference. It is a difference of orders of magnitude. It is the difference between having a comfortable nest egg and creating generational wealth. The 10-year question is your entry ticket to the exponential curve. The fifth and final pillar ties all the others together. It is the principle that provides the intellectual guardrails for this entire philosophy, the circle of competence. You can only confidently answer the 10-year question for a business that you genuinely and deeply understand. You cannot predict the 10-year future of an industry you know nothing about. Therefore, the 10-year rule has a powerful side effect. It forces you to be intellectually honest about the limits of your own knowledge. It compels you to stop chasing every hot trend and instead focus your investment efforts on the narrow slice of the economy where you have a genuine analytical edge. This disciplined focus is what Buffett calls staying within your circle of competence. It is perhaps the most important rule for avoiding catastrophic investment mistakes. The most dramatic example of Buffett applying this principle was his famous, and at the time widely mocked, decision to completely avoid technology stocks during the dot-com bubble of the late 1990s. As the new millennium approached, the world was gripped by internet fever. The stock market was on a tear, led by a new breed of technology and internet companies. Companies with no profits and often no revenue were going public and seeing their stock prices multiply overnight. It was a new paradigm, the pundits claimed. Old valuation metrics were dead. It was all about eyeballs, network effects, and land grabbing in the new digital frontier. During this period, Warren Buffett and Berkshire Hathaway became objects of ridicule. Their performance lagged the soaring NASDAQ index. Magazine covers famously depicted Buffett as a dinosaur, an old-fashioned investor who just didn't get it. He was relentlessly questioned about why he wasn't buying into the tech boom. His answer was simple, consistent, and profoundly wise. He would say, "I don't invest in things I don't understand." He admitted that he had no idea which of the hundreds of competing tech companies would be the winners in 10 years. He couldn't predict the future of their business models or their competitive advantages. The industry was changing too fast, and it was simply outside his circle of competence. He explained his thinking with an analogy. He said investing is like baseball, but a version where you can stand at the plate and watch thousands of pitches go by, and you never have to swing. You can wait for the perfect pitch, the one right in your sweet spot. For Buffett, his sweet spot was businesses like insurance, banking, and consumer staples, industries he had studied for decades and understood intimately. Technology stocks were a high, outside fastball that he was happy to let go by. His discipline was tested daily as he watched others around him get fabulously rich, at least on paper. But he refused to be drawn into a game he didn't understand. Then, in the spring of 2000, the bubble burst. The Nasdaq crashed over 80%. The high-flying tech darlings of yesterday became the bankruptcies of tomorrow. Investors who had chased the hype saw their portfolios vaporized. And Warren Buffett, the dinosaur, was vindicated in the most spectacular fashion possible. His patient, disciplined approach had not only preserved Berkshire's capital during the crash, but had left him with a mountain of cash to deploy into the wreckage at bargain prices. His adherence to his circle of competence, enforced by the 10-year question, saved him from the single greatest speculative mania of his lifetime. Buffett's powerful discipline during the tech bubble is a masterclass in overcoming two of the most dangerous cognitive biases for an investor: the Dunning-Kruger effect and overconfidence bias. The Dunning-Kruger effect is a cognitive bias in which people with low ability at a task overestimate their ability. Essentially, they are too incompetent to recognize their own incompetence. During the dot-com boom, millions of novice investors, armed with a new online brokerage account and a few hot tips, suddenly believed they were stock-picking geniuses. They mistook a bull market, where everything was going up, for their own skill. They ventured far outside any area of actual knowledge, buying complex biotech or software companies based on a flimsy understanding, because they were overconfident in their own analytical abilities. The 10-year question is a powerful antidote to the Dunning-Kruger effect because it forces a moment of profound intellectual humility. It's one thing to have an opinion on whether a stock will go up next week. It's another thing entirely to have a deeply researched, evidence-based conviction about a company's competitive position in the year 2034. This question forces you to confront the limits of your knowledge. Can I really predict the winner of the artificial intelligence race? Do I truly understand the semiconductor industry supply chain? For most things, for most people, the honest answer is no. This leads to overconfidence bias, our general tendency to be more confident in our own judgments than is objectively warranted. We all tend to overestimate our ability to predict the future. The 10-year question acts as a calibration tool for this bias. By forcing such a long time horizon, it makes the inherent uncertainty of the future starkly apparent. This encourages you to gravitate toward businesses with more predictable futures. The future of a chewing gum company is, frankly, easier to predict than the future of a gene editing company. This doesn't mean you should never invest in technology. It means you should only invest in areas of technology that you understand as well as Buffett understands insurance. The principle is not anti-tech, it's anti-ignorance. For entrepreneurs, this principle is equally vital. It encourages them to stick to their core business, the industry they know best, rather than diversifying into areas where they have no competitive edge. Staying within your circle of competence is the key to sustained excellence in both investing and business. To make this principle actionable, you must engage in a simple but powerful exercise: mapping your circle of competence. This is a blueprint for defining your personal area of investment expertise. First, take out a blank sheet of paper or open a new document. At the top, write "My Circle of Competence." Now, divide the page into 3 columns. In the first column, list the industries or areas of business where you have a genuine, deep understanding. This understanding could come from your profession. If you're a doctor, you likely have an edge in understanding healthcare companies. If you're a software engineer, you have an edge in tech. It could also come from a lifelong hobby or passion. If you're a passionate gamer, you might have deep insights into the video game industry. Be brutally honest with yourself. This is not a list of things you find interesting. It's a list of things where your knowledge is superior to the average investor. In the second column, next to each industry, list the specific companies that operate within it. Now, for the most important part. In the third column, for each company, try to write a short paragraph answering the 10-year question. Why will this business be more prosperous and have a stronger competitive position a decade from now? This exercise will be difficult. You will find that for many companies, even in industries you thought you knew well, you cannot write a confident, evidence-based answer. That is the point. The companies for which you can write a compelling, detailed paragraph, those companies form the boundaries of your circle of competence. That is your hunting ground. Everything else is off-limits. This small, focused list is not a limitation. It is your superpower. It allows you to concentrate your time and mental energy on the opportunities where you have the highest probability of success. This process of self-assessment is a crucial step in professionalizing your approach to asset allocation and stock picking. It ensures that your investment decisions are rooted in genuine knowledge, not speculation. The antithesis of this disciplined approach is a common mistake that plagues many retail investor portfolios: diversification. The term, coined by legendary fund manager Peter Lynch, describes the practice of buying too many different investments in an attempt to be diversified, with the end result being a portfolio that is worse than if you had just bought a simple index fund. The diversifier believes they need to have a piece of every hot sector. They hear that clean energy is the future, so they buy a random solar stock they know nothing about. They read an article about the rise of e-commerce in Southeast Asia, so they buy an ADR of a company they can't pronounce. Their portfolio becomes a cluttered collection of dozens of small positions, an inch-deep, mile-wide assortment of stocks they don't truly understand. Because they don't understand the underlying businesses, they have no conviction. When one of their speculative bets goes down, they don't know if it's a temporary dip or a sign of permanent trouble, so they often sell at the worst time. They have all the downsides of owning individual stocks, the risk, with none of the upsides, the potential for outsized returns from a few big, concentrated winners. This behavior stems from a misunderstanding of true diversification. Diversification is not about how many stocks you own. It's about how many different, uncorrelated risk profiles you are exposed to. Owning 20 different money-losing tech stocks is not diversification. A portfolio of 10 carefully selected, deeply understood businesses in 5 different, predictable industries is far more robust. The circle of competence provides the framework for building this kind of concentrated, high-conviction portfolio. It is the cure for diversification. It forces you to make fewer, better bets. As Warren Buffett has famously said, wide diversification is only required when investors do not understand what they are doing. By mapping and respecting the limits of your own competence, you move from the amateur world of diversification to the professional world of intelligent concentration. The direct financial connection of staying within your circle of competence is the dramatic reduction of unforced errors and what investors call stupid risk. Stupid risk is the risk you take on without being adequately compensated for it, usually because you don't understand the investment well enough to properly assess the dangers. When you invest in a business you understand deeply, you gain a powerful informational and analytical edge. You are better able to distinguish between a temporary problem and a permanent impairment of the business. This was the key to Buffett's success with American Express in the salad oil scandal. His understanding of the brand's power allowed him to see the temporary nature of the problem, while others, who did not understand the business as well, saw only permanent disaster. This ability to act rationally when others are panicking is a massive source of long-term outperformance. It allows you to buy great businesses at bargain prices, precisely when they are most out of favor. Furthermore, a deep understanding of a business allows you to hold with conviction through the inevitable periods of volatility. If you own a stock simply because it's going up, you will surely sell it when it starts to go down. But if you own a business because you understand its long-term value creation potential, a falling stock price will not shake you. In fact, you may even welcome it as an opportunity to increase your ownership stake at a better price. This conviction, born from competence, is what allows you to ride out market storms and capture the full long-term return of your best ideas. Over an investing lifetime, the financial impact of avoiding just 1 or 2 major blow-ups, like the dot-com crash, is immense. By staying within your circle of competence, you are not just aiming to pick more winners, you are systematically avoiding the catastrophic losers that can permanently cripple a portfolio. This defensive-minded approach, this relentless focus on avoiding stupid mistakes, is the final, crucial link in the chain of the 10-year philosophy. It is the governor on the engine, ensuring that your journey towards financial freedom is not just rapid but safe. You have just been given a powerful mental tool. This framework, built around Warren Buffett's 10-year question, is more than just an investing tactic. It is a complete operating system for making rational, long-term decisions in a world that constantly pushes you to think short-term. By internalizing these 5 pillars, adopting an owner's mindset, using the 10-year test as a quality filter, ignoring the noise, harnessing the power of compounding, and respecting your circle of competence, you have fundamentally rewired your approach to building wealth. You now possess the blueprint to move from a place of speculation and anxiety to a position of ownership, patience, and quiet confidence. But it is crucial to understand that what you have just mastered, as powerful as it is a single critical node in a much larger network of mental models. Warren Buffett's success is not the result of one single idea, but the interplay of dozens of interconnected principles that work together like a lattice work of thought. The 10-year question is the foundation, but it is supported by and connected to other frameworks for valuing a business, assessing management quality, and understanding market psychology. You have just acquired one of the most important pieces of the map, but the journey to completing your mental arsenal has just begun. The video that is now appearing on your screen is not an accident. The algorithm has identified it as the next logical step in your journey, the missing link. It contains the piece of the puzzle that connects directly to what you have just learned, a model that will amplify the power of the 10-year question and deepen your understanding of the entire system. To click away now would be to leave with an incomplete toolkit. The choice is yours. Are you someone who is content with a single insight? Or are you someone who is committed to completing the entire intellectual arsenal required for true, lasting financial success? The path forward is right there. Continue your ascent. Click and master the next piece of the map.